Before we begin, please remember that I am not a financial advisor, and this video is for educational and informational purposes only. The content of this presentation is not intended to be a substitute for professional financial advice. Investing involves risk, including the potential loss of principal. Always conduct your own research and consult with a licensed financial professional before making any investment decisions. Remember the spring of 2020? The world was on lockdown, the roads were empty, and something happened that financial experts thought was impossible. The price of oil went negative. Think about that. For a brief, insane moment, companies were literally paying people to take barrels of oil off their hands because they had nowhere to store it. It was absolute chaos. It looked like the end of the world for the energy industry. Fast forward just 2 years, and energy stocks were the #1 performing sector in the entire S&P 500. While tech stocks and crypto were crashing, investors who held on to energy were seeing some of the biggest gains of their lives. So what's the secret? How did ordinary people like you and me, capitalize on this massive rebound without having to be an oil tycoon or a Wall Street genius who could predict the future? The answer for many wasn't about gambling on one single company. It wasn't about trying to pick the one winning oil driller or the one revolutionary solar company from a sea of thousands. It was about using a tool that most people have heard of, but few truly understand in this context: a mutual fund. Specifically, an energy mutual fund. You see the headlines every single day. Gas prices are soaring. A conflict halfway around the world makes your utility bill jump. The transition to green energy is creating new winners and losers. Feels complicated, volatile, and honestly a little scary to invest in. You know there's massive opportunity there. Energy is what powers our entire modern world after all, but the risk feels just as massive. What if you pick the wrong stock? What if you invest in a company that goes bankrupt? This is the exact problem we are going to solve for you right now. In this video, I'm going to pull back the curtain on one of the most powerful and accessible ways for a US investor to get a piece of the entire energy industry. We are going to break down, in simple, plain English, what an energy mutual fund is. We'll explore how it allows you to invest in everything from the titans of oil and gas like ExxonMobil and Chevron, to the pipeline companies that move that energy across the country, and even the innovative renewable energy companies building our future, all with a single investment. By the end of this, you won't just know what an energy mutual fund is. You'll understand how they work, the pros, the cons, and how to determine if this powerful investment tool has a place in your own financial journey. So let's start with a simple analogy. Imagine you and 100 of your friends want to throw the ultimate American barbecue. The problem is, no single person can afford to buy the high-end grill, the prime-grade steaks, the craft beer, the gourmet sides, and everything else needed to make it truly epic. So you decide to pool your money. Everyone chips in, say, $50. Suddenly, your collective buying power is immense. You can afford the best of everything. And to make sure the money is spent wisely, you nominate the one friend who's a professional chef to make all the purchasing decisions. A mutual fund is almost exactly like that. It's a giant pool of money collected from thousands of investors, just like you, and that pool of money is then handed over to a professional, a fund manager, our chef, who uses it to buy a wide variety of investments. In our case, instead of buying steaks and grills, this manager is buying stocks and bonds in energy companies. You, as an investor, buy a share of the fund, which is like your ticket to the barbecue. Your single share represents a tiny ownership stake in everything the fund owns, dozens, sometimes hundreds, of different energy companies. Now, why would you want to do this specifically for the energy sector? To answer that, we need to take a quick trip back in time. Picture this. It's 1973. Bell-bottoms are in style, the sound of Led Zeppelin is on the radio, and long lines of cars are snaking around city blocks, waiting for gasoline. The OPEC oil embargo has sent shockwaves through the American economy. The price of a barrel of oil quadruples almost overnight. For the average American, it was a nightmare. But for the owners of domestic oil companies, it was a gusher of unprecedented profits. Imagine you were an investor back then. You saw what was happening and thought, I need to get in on this. I need to own a piece of an oil company. So you take your hard-earned savings and you buy stock in one company. Let's call it Wildcat Oil Drilling. For a while things are great. The stock soars. But then disaster strikes. Wildcat Oil's big exploratory well in Texas comes up dry. A total bust. The company's value plummets, and your investment gets wiped out. Meanwhile, another company right next door, Texas Gusher Incorporated, hits the motherlode and its stock goes to the moon. You picked the wrong horse. This is the fundamental dilemma of investing in the energy sector. It's a world of breathtaking booms and devastating busts. The potential for reward is massive, but the risk of picking a single loser and losing your shirt is equally huge. It's a high-stakes game of geology, geopolitics, and technology. For the average person, trying to navigate this landscape alone is like trying to captain an oil tanker through a hurricane with nothing but a rowboat paddle. This is the problem that energy mutual funds were designed to solve. Instead of forcing you to bet everything on a single company like Wildcat Oil, an energy mutual fund spreads your investment across the entire energy landscape. That professional fund manager, the expert you've hired with your pooled money, doesn't just buy one stock. They buy a carefully selected portfolio. They might buy some shares of a massive stable giant like ExxonMobil or Chevron, the big reliable players. They'll also buy stock in a pipeline company, the ones that act like toll collectors for the oil and gas that flows across the country. They might even buy into a specialized oilfield services company that provides the high-tech drilling equipment. So now if Wildcat Oil goes bust, it's a bummer, but it's only one small piece of your overall investment. The success of Texas Gusher Incorporated, and the steady profits from the pipeline company, and the dividends from ExxonMobil help offset that loss. You're no longer tied to the fate of a single well in Texas. You're invested in the success of the American energy industry as a whole. This principle is the single most important concept in modern investing. Diversification. It's the financial equivalent of not putting all your eggs in one basket. So what exactly is inside one of these funds? What are you actually buying? It's not just oil companies. The energy sector is a complex ecosystem with three main parts, and most funds will invest across all of them. First, you have the upstream companies. These are the explorers and producers. Think of them as the adventurers, the modern-day prospectors. They're the ones leasing land, conducting seismic surveys, and drilling deep into the earth or out into the ocean, searching for new reserves of oil and natural gas. This is the highest risk, highest reward part of the business. When they strike oil, the payoff can be astronomical. When they drill a dry hole, the losses can be catastrophic. Companies like ConocoPhillips or Pioneer Natural Resources are major players here. Next, you have the midstream companies. These are the truckers and railroad operators of the energy world. They own and operate the vast network of pipelines, storage tanks, and transportation systems that move oil and gas from the wellhead to the refinery. Their business model is often fee-based, like a toll road. They get paid for the volume of energy that passes through their system, which makes their profits less sensitive to the volatile price of oil itself. They provide a layer of stability to the sector. Think of companies like Kinder Morgan or Enterprise Products Partners. Finally, there are the downstream companies. This is the part of the industry you interact with every day. These are the companies that take the raw crude oil, refine it into gasoline, diesel, and jet fuel, and then market and sell it to consumers at the gas pump. Their profits are often tied to the crack spread, the difference between the price they pay for crude oil and the price they get for the refined products. Valero Energy and Marathon Petroleum are giants in this space. A good energy mutual fund manager builds a portfolio that strategically balances these different types of companies. They're like a coach building a football team. They need the flashy, high-scoring quarterbacks, the upstream explorers, but they also need the big, reliable offensive linemen who protect the quarterback and grind out steady gains, the midstream pipeline operators, and the receivers who make the final play at the goal line, the downstream refiners. And today, the definition of energy is expanding. Many modern energy funds are no longer just about fossil fuels. They're also investing in the future. They might hold shares in solar companies, wind turbine manufacturers, or leaders in battery technology and electric vehicle charging infrastructure. This adds another layer of diversification, allowing you to invest not only in the energy that powers our world today, but also in the energy that will power it tomorrow. So, to recap the mechanics, you decide you want to invest $1,000 in energy. Instead of trying to pick one or two stocks yourself, you buy $1,000 worth of shares in an energy mutual fund. Your money is instantly pooled with millions of dollars from other investors. A team of full-time analysts and a professional fund manager, who spend their entire day researching the energy market, take that pool of money and invest it in a diversified portfolio of maybe 50 to 100 different energy-related companies, upstream, midstream, downstream, and maybe even some renewables. Your $1,000 investment now owns a tiny slice of every single one of those companies. You get the benefit of professional management and instant diversification, two things that would be nearly impossible to achieve on your own without a massive amount of capital and expertise. You've effectively outsourced the hard work, the research, the stock picking, the constant monitoring to a pro. This structure is what makes a complex and volatile sector, like energy, accessible to the everyday American investor. It turns a high-stakes gamble into a strategic investment. But this convenience and professional oversight isn't free. And the specific strategy a fund manager uses can dramatically change your results. Some funds are built for steady income, others are built for aggressive growth, and some are hiding risks that can decimate your portfolio if you're not paying close attention. Understanding the key differences between them is absolutely critical before you ever invest a single dollar. So let's pull back the curtain. Think of the energy sector not as one giant industry, but as 4 distinct neighborhoods, each with its own culture, its own rules, and its own risk profile. When you buy an energy mutual fund, you're essentially buying a collection of real estate in one or more of these neighborhoods. The first and most famous is the land of the giants. These are the integrated oil and gas funds. This is where the household names live: ExxonMobil, Chevron, Shell. The titans of the industry. They're called integrated for a reason. They do everything. They own the oil wells drilled a mile under the ocean floor, they own the supertankers that carry the crude across the globe, they own the massive refineries that turn it into gasoline, and they often own the gas station on the corner where you fill up your car. They control the entire supply chain from the ground to your tank. This is their superpower. When you invest in a fund focused on these giants, you're buying stability, or at least the energy sector's version of it. Because they control the whole process, they can make money in different ways. If the price of crude oil is high, their drilling operations, what we call upstream, are printing cash. If the price of crude is low, their refining operations, or downstream, can actually become more profitable because their main ingredient just got cheaper. This integration creates a natural hedge. It smooths out the violent swings of the energy market. These funds are the battleships of the energy world. They're enormous, they're powerful, and they're slow to turn. They often pay reliable dividends, which makes them attractive to investors looking for income. But don't expect them to double in a year. Their sheer size makes explosive growth incredibly difficult. For every billion in profit they make, it barely moves the needle on their multi-hundred-billion-dollar valuation. This is the slow and steady neighborhood. But right next door you have a neighborhood that is the polar opposite. This is the land of the wildcatters. These are the funds focused purely on exploration and production, or E&P. This is the high-stakes, high-reward world of upstream energy. The companies in these funds don't own refineries or gas stations. They have one job and one job only: find and pull oil and gas out of the ground. Think of them as modern-day gold prospectors. They spend hundreds of millions of dollars drilling a hole in the earth, betting everything that they'll strike it rich. When they hit a massive reserve and oil prices are high, the returns can be astronomical. Their stock prices can go parabolic. It's not uncommon to see these companies jump 10, 20, or even 30% in a single week when things are going their way. An E&P-focused mutual fund captures that explosive upside across dozens of these companies. This is where you find the life-changing gains. But the flip side of that coin is terrifyingly sharp. If they drill and find nothing, that's millions of dollars lit on fire. And worse, these companies are complete slaves to the price of oil. If crude oil drops from $80 a barrel to $50, their profit margins can evaporate overnight. Their entire business model can become unprofitable in a matter of months. A fund loaded with these stocks can get cut in half or worse during a downturn. This is the neighborhood for investors with a stomach for extreme volatility, who are making a direct, aggressive bet on rising energy prices. It's pure adrenaline. Now let's move to the third neighborhood. It's not as glamorous as the first two, but for a certain type of investor, it's the most beautiful place on earth. This is the land of the toll collectors. These are the midstream energy funds. Midstream companies are the FedEx and the Amazon Web Services of the energy world. They don't drill for oil and they don't sell you gas. They own the infrastructure that connects the drillers to the refiners. We're talking about the thousands of miles of pipelines that crisscross the country, the massive storage tanks, the processing facilities. They are the essential plumbing of the entire industry. And here's the magic. Their business model is often fee-based. They get paid for the volume of oil or gas that moves through their system, not its price. They are, in effect, a toll booth on the energy superhighway. Whether a barrel of oil is worth $100 or $40, they still collect their toll for shipping it. This makes them far more insulated from the wild price swings we see in the other neighborhoods. As a result, funds focused on these companies tend to generate very consistent, very predictable cash flow. and they pass that cash flow on to investors in the form of high dividend yields. But there's a critical detail here you absolutely must know, especially as a U.S. investor. Many of these midstream companies are structured as master limited partnerships, or MLPs. This structure allows them to avoid paying corporate income tax, which is how they can afford to pay out such high dividends. However, it comes with a major catch for you, the investor. Instead of receiving the simple 1099 DIV form you get from most dividend stocks, an MLP will send you a complex Schedule K-1 tax form. This form can be a nightmare to deal with. It often arrives late, and it can make filing your taxes significantly more complicated and expensive. Some mutual funds are set up to handle this complexity for you, but others pass it right along. Ignoring this detail can lead to a very nasty surprise come tax season. Finally, we have the fourth neighborhood, the one that's being built right now with a blueprint for the future. This is the land of the disruptors, the clean and renewable energy funds. These funds are a completely different animal. They aren't investing in oil and gas at all. They're buying into companies building massive solar farms in the desert, erecting wind turbines off the coast, and pioneering the next generation of battery storage technology. This is where you'll find names like NextEra Energy, or a whole basket of innovative solar, wind, and hydrogen companies. Investing here isn't a bet on the price of a barrel of oil. It's a bet on a fundamental multi-decade shift in how the world generates power. The growth potential is immense. You're getting in on the ground floor of what could be the biggest industrial transition in a century. Government policies like the Inflation Reduction Act here in the US are pouring hundreds of billions of dollars into this space, acting as a massive tailwind. But this neighborhood is still under construction. It's speculative. Many of these companies are not yet profitable. Their stock prices are often based on future promise, not current earnings, which can lead to insane valuations and gut-wrenching volatility. A change in government policy or a competitor achieving a technological breakthrough can send a stock soaring or crashing. Investing here requires patience and a strong belief in the long-term vision, because the road to a clean energy future will be anything but smooth. So there you have it. The four distinct neighborhoods: the stable, dividend-paying giants; the high-risk, high-reward wildcatters; the steady, income-generating toll collectors with their tricky tax implications; and the speculative, future-focused disruptors. Each one is designed for a completely different type of investor with a different goal. But here's the million-dollar question. When you're looking at a list of 100 different energy funds online, how do you actually know which neighborhood you're buying into? How can you look at a fund's name and its summary page and instantly tell if it's a battleship, a wildcatter, or something else entirely? Because the fund's name can be incredibly misleading, and the marketing documents will always make it sound like the perfect investment. The secret is to ignore the cover of the book and read the first few pages. For a mutual fund, that crucial first chapter is a document that 99% of people either throw in the trash or delete without opening. It's called the prospectus, and it is your secret decoder ring. It's the fund's legally binding owner's manual, and in a world of slick marketing, it is the only source of truth. It's not written to be exciting. It's written to keep the fund's lawyers out of trouble with the Securities and Exchange Commission, the SEC. And that's exactly why it's so valuable. It forces the fund to tell you, in painfully specific detail, exactly what it's going to do with your money. So, when you get that dense, boring-looking PDF, don't just archive it. Open it. You don't have to read all 100 pages. You just need to know where to look. We're going on a treasure hunt, and the map is the table of contents. You're looking for 3 specific sections. First, the fund's investment objective. Second, its principal investment strategies. And third, the principal risks. These 3 sections are your X-ray glasses. They let you see the fund's skeleton, its true intentions, completely stripped of all the marketing hype. Let's start with the investment objective. This is usually a single sentence right at the top. It's the fund's mission statement. Is it seeking long-term capital appreciation? That's code for we're trying to make the stock price go up, and we're willing to take risks to do it. This is the language of a wildcatter. Or is it seeking current income? That's code for we're focused on generating regular cash flow, primarily through dividends. This is the language of a battleship. Sometimes it'll say it seeks a combination like growth and income, which means it's trying to be a hybrid. Right away, this one sentence gives you a massive clue about the fund's personality. But the objective is just the destination. The second section, principal investment strategies, is the GPS route. This is the most important part of the prospectus. It tells you how the fund plans to achieve its objective. This is where you separate the contenders from the pretenders. It will usually start with a sentence like, under normal market conditions, the fund invests at least 80% of its net assets in securities of companies in the energy sector. Okay, that's the basics. But the magic is in the details that follow. What kind of companies? Does it say large capitalization companies? If so, you're looking at a fund that owns the big boys, the Exxons, the Chevrons, the Shells. These are our battleships. They're massive, established, and generally less volatile. Or does it say it focuses on small and mid-capitalization companies? Now we're in wildcatter territory. These are the smaller, more nimble, and often much riskier players who could either strike it big or go bust. Where in the energy supply chain does it invest? Does the strategy say it focuses on midstream companies, like pipeline and storage operators? Those tend to be more stable, income-oriented businesses. That's a battleship characteristic. Or does it say it concentrates on upstream companies, specifically in exploration and production? That's the definition of a wildcatter. They are literally drilling for treasure, and sometimes they find it, and sometimes they find nothing but dirt and debt. Does it mention geography? A fund that invests primarily in U.S. companies has a very different risk profile than one that invests in emerging markets, where you add geopolitical instability and currency fluctuations to the already volatile energy market. This section will also tell you if the fund uses complex or risky instruments. Do you see words like derivatives, options, futures, or short selling? Those are red flags that you are dealing with a highly aggressive, speculative fund. A true battleship fund rarely, if ever, uses these. A wildcatter might use them to try and juice returns, adding another layer of complexity and risk. Finally, you get to the third section, principal risks. I love this section. It's like the fund is legally required to give you a private tour of all the ways it could lose your money. The marketing team hates this section, but you should treat it as your best friend. It's the fund's confession. Every energy fund will list market risk, the risk that the whole stock market goes down. Ignore that, it's generic. You're looking for the specific, energy-related risks. You'll see commodity price risk. This is the big one. It's the fund admitting that if the price of oil or natural gas plummets, the value of its holdings will likely plummet too. Every energy fund has this risk, but it's much more pronounced for the wildcatters focused on exploration. A pipeline company gets paid for volume, so it's less sensitive to the price of the commodity itself. An oil driller's entire profitability hinges on that price. You might see regulatory risk. This means a change in government policy like new environmental laws or a ban on fracking could cripple the companies the fund owns. You might see geopolitical risk if it invests overseas, or exploration risk, which is the fund explicitly telling you that the companies it owns might spend billions drilling a hole and find absolutely nothing. The more terrifying and specific the list of risks, the more of a wildcatter you're looking at. Let's put this into practice with two hypothetical funds. First up is the American Heartland Energy Income Fund. The name sounds safe, stable, patriotic. The marketing brochure shows a picture of a happy retired couple looking at a pipeline stretching into a sunset. The objective in the prospectus says, seeks to provide a high level of current income. Okay, that's our first clue. It's a battleship. The strategy says, the fund invests at least 80% of its assets in dividend-paying equity securities of U.S.-based, large capitalization companies in the energy midstream subsector, including pipeline, storage, and processing companies. Boom, there it is. Large cap, U.S.-only midstream pipelines. That is the textbook definition of a battleship strategy. The risk section confirms it. It lists interest rate risk, because income-oriented stocks can be sensitive to rising rates, and concentration risk, because it's focused on one specific subsector. It's clear, it's conservative, it's a battleship. Now let's look at the Global Energy Discovery Fund. The name sounds exciting, adventurous, full of upside. The marketing shows a rocket ship. The prospectus objective says, seeks to provide long-term capital appreciation. That's our wildcatter signal. The strategy section is where it gets really interesting. The fund invests in a global portfolio of small and mid-capitalization companies engaged primarily in the upstream exploration and production of oil and natural gas. The fund may invest up to 30% of its assets in companies located in emerging markets. The fund may also utilize derivatives, including options and futures, to enhance returns or hedge against market downturns. Do you see the difference? Global. small cap, upstream exploration, emerging markets, derivatives. Every single one of these is a flashing neon sign that says, high risk. This is a pure wildcatter, and the risk section will be a horror story. It will list everything: extreme commodity price risk, emerging market political risk, currency risk, exploration risk, derivatives risk, and high volatility. The fund is screaming at you that it's a roller coaster. The names were American Heartland versus Global Discovery. One sounds like a warm blanket, the other like an adventure. But the names meant nothing. The truth, the entire DNA of each fund, was laid bare in just 3 small sections of the prospectus. Learning to read this document is like being a detective. You're not taking the suspect's word for it. You are dusting for fingerprints, reading the case file, and uncovering the hard evidence. This is the single most powerful and most underutilized skill for any mutual fund investor. You now know how to bypass the marketing and talk directly to the fund's legal department. You know how to identify its core mission, its game plan, and all the things that can go wrong. You can now, with confidence, pick up any energy mutual fund and in 5 minutes, determine if it's a slow and steady battleship built for income, or a high-octane wildcatter built for speculative growth. But this is only half the battle. Knowing the fund's strategy is one thing. The next step is to look under the hood and see the actual companies it owns, because the prospectus tells you the rules of the game the manager is playing. The holdings report shows you the players they've actually put on the field. And sometimes the star players on the team aren't who you'd expect at all. So who are these unexpected players? Well, to understand that, you have to understand that the word energy is a universe, not a single star. When you hear energy stocks, your mind probably jumps straight to the giant, familiar logos you see at the gas station: ExxonMobil, Chevron, Shell. And yes, they are the supermassive stars of this universe. But they are far from the only thing out there. An energy mutual fund is a portfolio manager's attempt to capture the light from all sorts of celestial bodies in this universe, from blazing suns to stable, slow-burning dwarfs. The energy sector is really a 3-act play, a massive industrial process with distinct stages. And the companies in your mutual fund will specialize in one, or sometimes all of these acts. First, you have what's called upstream. Think of this as the treasure hunt. These are the exploration and production companies, or E&P for short. Their entire business is finding pockets of oil and natural gas trapped miles beneath the Earth's surface and pulling it out of the ground. These are the modern-day wildcatters, the risk-takers. They spend billions on geological surveys, seismic imaging, and drilling exploratory wells that might turn up completely dry. But when they hit a gusher, the payoff can be astronomical. Companies like ConocoPhillips or Pioneer Natural Resources live and die in this part of the industry. Their fortunes are chained almost directly to the real-time price of a barrel of crude oil or a cubic foot of natural gas. When energy prices are soaring, these companies print money. Their stock prices can go parabolic. But when the price of oil crashes, they can bleed cash, shut down rigs, and their stocks can get absolutely hammered. An energy fund manager who is extremely bullish on the price of oil might load up on these upstream players, betting on that explosive, high-risk, high-reward upside. Next, you have the second act, midstream. Once the oil and gas is out of the ground, it has to get from the remote oil field in West Texas or North Dakota to the places where it will be processed and used. That's the job of midstream companies. They are the logistics and transportation backbone of the entire industry. They own and operate the vast networks of pipelines, the massive storage tanks, the processing facilities, and the shipping terminals. Think of them less like treasure hunters and more like the operators of a toll road. Their business isn't primarily about the price of the commodity passing through their pipes. It's about the volume. They get paid a fee for every barrel of oil or every unit of natural gas they transport or store. This makes their cash flows much more stable and predictable than the upstream drillers. Companies like Enterprise Products Partners or Kinder Morgan are giants in this space. Because of this stability, midstream companies are famous for paying out consistent, often generous, dividends to their shareholders. They're the workhorses, not the racehorses. So, if a mutual fund manager wants to build an energy fund that generates steady income for its investors, they will heavily favor these midstream companies. It's a completely different strategy, focused on cash flow instead of explosive growth. Finally, we have the third act, downstream. This is where the raw crude oil is turned into the products you actually use every day. We're talking about the massive, complex refineries that crack crude oil into gasoline, diesel, jet fuel, heating oil, and the chemical building blocks for plastics. It also includes the marketing and retail side. Yes, the very gas stations where you fill up your car. Valero and Marathon Petroleum are huge players here. Now here's the fascinating and often misunderstood part about downstream companies. Their profitability is not necessarily about high oil prices. In fact, sometimes they do better when crude oil prices are falling. Their profit is determined by something called the crack spread, which is the price difference between the raw crude oil they buy and the refined products they sell. If the price of gasoline stays high but the price of the crude oil they need to make it suddenly gets cheaper, their profit margins explode. It's a subtle but critical distinction. A fund manager might buy downstream stocks as a way to hedge their bets, providing a potential cushion if the price of crude oil takes a nosedive. So you have the treasure hunters upstream, the toll road operators midstream, and the factories and storefronts downstream. But there's another major category, the integrated majors. These are the titans I mentioned earlier: ExxonMobil, Chevron. They're called integrated because they do everything. They have upstream operations drilling for oil all over the world. They have their own midstream assets like pipelines and tankers to move it. And they have their own downstream refineries and branded gas stations to sell the final product. This diversification makes them far more resilient than a company focused on just one part of the value chain. If their upstream drilling business is suffering from low oil prices, their downstream refining business might be booming from those same low prices, smoothing out the overall results. They are the giant, diversified superconglomerates of the energy world. Nearly every single general energy mutual fund will have these giants as their top holdings, because they offer broad exposure to the entire industry in a single stock. And we're not even done. There's one more critical group of players you'll find: oilfield services companies. These are the companies that sell the picks and shovels during the gold rush. They don't actually own or produce any oil themselves. Instead, they provide the specialized equipment, technology, and manpower that the upstream E&P companies need to do their jobs. We're talking about companies like Schlumberger and Halliburton. They provide everything from drill bits and hydraulic fracturing services to seismic imaging software. Their business booms when drilling activity is high. When oil prices are up, E&P companies get excited and spend a ton of money drilling new wells, and that money flows directly to the oilfield services companies. When prices crash, drilling budgets get slashed, and these companies are the first to feel the pain. A fund manager might buy these stocks when they believe the industry is entering a new cycle of investment and expansion. So now, when you look at that holdings report for an energy mutual fund, you can see it with a whole new level of clarity. You're not just seeing a list of names. You're seeing a strategy. Is the fund manager making a high-risk bet on rising oil prices by loading up on upstream E&P stocks? Are they playing it safe and aiming for income by focusing on midstream pipeline companies? Or are they taking a balanced approach with a heavy dose of the integrated majors? The composition tells the story of the manager's worldview. And here's the final modern twist. You might open a fund's holdings report and find something you didn't expect at all. A solar panel manufacturer, or a wind turbine company, or a utility that's heavily invested in renewables. The definition of energy is changing. Some fund managers are looking to the future, positioning their portfolios for the energy transition. They might call it an energy evolution fund or a future of energy fund. Others might be traditional oil and gas funds that are simply starting to dip their toes into renewables as a small speculative part of their portfolio. This is why you absolutely have to look under the hood. The name on the fund is just the book cover. The holdings report is the actual story. It tells you if you're buying a fund dedicated to the energy sector of the last 100 years, or one that's trying to capture the energy sector of the next 100. So you've looked under the hood, you see the different parts of the engine, the upstream pistons, the midstream fuel lines, the downstream exhaust. You understand how they work together. But what happens when this engine sputters? What happens when the price of oil crashes, or a pipeline springs a leak, or a government suddenly changes the rules of the game? Understanding the machine is one thing. Understanding what can break it is everything. And the biggest risks in the energy sector aren't always the ones you see coming. Let's break down these risks into 3 categories. Think of them as the 3-headed monster guarding the treasure of energy investing: geopolitical risk, regulatory risk, and good old-fashioned market volatility. Get to know them, and you'll be far better prepared for the fight. First, let's talk about geopolitical risk. This is the big one. The global chess match where oil fields are the squares and entire nations are the pieces. Energy is power, literally and figuratively. Countries go to war over it. They form alliances and cartels to control its price and flow. And your mutual fund can get caught in the crossfire. Imagine it's 1973. You're an American investor, and your portfolio has a healthy slice of big oil companies. Life is good. Then thousands of miles away, a conflict erupts in the Middle East, the Yom Kippur War. In response, the Organization of Arab Petroleum Exporting Countries, or OPEC, decides to punish the United States for its support of Israel. They declare an oil embargo. Suddenly, the spigot is turned off. The effect is immediate and devastating. Gas stations across America run dry. Cars line up for blocks, sometimes for days, just to get a few gallons of precious fuel. The price of everything skyrockets. The stock market tumbles. And that healthy energy portion of your portfolio? It's now in critical condition. A decision made in a boardroom in Kuwait City directly impacted the life of a factory worker in Detroit and an investor in Des Moines. That is geopolitical risk in its rawest form. And it's not some relic of the past. Think about the Strait of Hormuz, a tiny maritime choke point through which about a fifth of the entire world's daily oil supply passes. Tensions flare up there with Iran, and the global price of oil can spike in a matter of hours. Think about Russia using its vast natural gas reserves as a political weapon against Europe. When a pipeline's flow is reduced for political reasons, it sends shockwaves through the market. So when you look at an energy mutual fund, you have to ask, where are its companies operating? A fund heavily invested in companies with stable operations primarily in Texas, North Dakota, or the Gulf of Mexico has a very different geopolitical risk profile than a fund with significant holdings in companies drilling in West Africa, the Middle East, or politically volatile regions of South America. The potential rewards in those riskier places can be higher, but so is the chance that a sudden coup, a civil war, or a new round of sanctions could render those assets worthless overnight. The fund manager isn't just picking stocks. They're placing bets on global stability. Now let's bring the risk closer to home. The second head of the monster is regulatory risk. The threat doesn't always come from a foreign power. Sometimes it comes from a pen stroke in Washington, D.C. or a state capital. The energy industry is one of the most heavily regulated sectors in the economy, and the rules can change dramatically with the political winds. Let me tell you a story about a project called the Keystone XL pipeline. For years, it was a massive undertaking, designed to carry hundreds of thousands of barrels of oil per day from the fields of Canada down to refineries in the United States. Billions of dollars were invested. Contracts were signed. People were hired. It was approved by one presidential administration, seen as a key piece of North American energy infrastructure. Then, a new administration came into office with a different set of priorities, focusing more on climate change and environmental protection. One of the first acts of the new president was to revoke the pipeline's permit. Just like that, billions of dollars in investment gone. The project was dead. The companies involved saw their stock prices take a major hit. That is regulatory risk. It's the uncertainty that a new law, a new tax, or a new environmental standard could completely change a company's financial future. Will the Environmental Protection Agency, the EPA, enact stricter emissions standards on refineries? That could cost billions in upgrades. Will a state government ban the practice of hydraulic fracturing, or fracking? That could wipe out the primary business model for dozens of smaller producers. It can also work the other way. An administration might roll back regulations, opening up new areas for drilling and exploration, which could be a boon for energy companies. They might offer tax credits and subsidies for certain types of energy production. This is why you see the energy sector's fortunes so closely tied to election cycles. A fund manager has to be part political analyst, trying to forecast which way the regulatory tide is turning. A fund that is heavily concentrated in, say, offshore drilling companies is making a huge bet that the government will continue to grant offshore leases. If that policy changes, the fund's core thesis could evaporate. Finally, we arrive at the third, and perhaps most wild and untamable head of the monster, market volatility. Even if the world is at peace and the regulators are friendly, you have to contend with the brutal cyclical nature of the commodity markets themselves. The price of oil and natural gas is not a stable, gentle slope. It's a violent roller coaster with terrifying peaks and stomach-churning drops. This volatility is driven by the fundamental laws of supply and demand. When the global economy is booming, factories are humming, people are driving and flying, demand for energy is high, prices go up. Energy companies make record profits, their stocks soar, and energy mutual funds deliver incredible returns. This is the boom. But what happens when a global recession hits? Or say a once-in-a-century pandemic shuts down the entire world? That's what happened in 2020. Demand for energy didn't just fall. It fell off a cliff. Suddenly nobody was flying. Hardly anyone was driving to work. The world was swimming in oil it didn't need. This led to one of the most bizarre moments in modern financial history. On April 20, 2020, the price of a barrel of West Texas Intermediate crude oil didn't just go to zero. It went negative. For a brief period, sellers were literally paying buyers almost $40 to take a barrel of oil off their hands. Why? Because the physical storage tanks in places like Cushing, Oklahoma were completely full. There was nowhere left to put the oil that was still gushing out of the ground. It was cheaper to pay someone to take it than to find a place to store it. Think about the impact of that. The core product of these massive companies was, for a moment, worth less than nothing. Their revenues evaporated. Profits turned into massive losses. Bankruptcies swept through the sector, especially for smaller, more leveraged companies. The stocks of even the biggest, most stable energy giants plummeted, and every single energy mutual fund went down with them. This is the boom and bust cycle. It's inherent to the industry. High prices encourage more drilling and investment, which eventually leads to an oversupply. That oversupply causes prices to crash. The crash forces companies to cut back, slash investment, and even go bankrupt, which eventually leads to an undersupply. That undersupply causes prices to spike again, and the cycle begins anew. When you invest in an energy mutual fund, you are strapping yourself into this roller coaster. The key is knowing where you are in the cycle and having the stomach to handle the ride. Geopolitical conflict, regulatory whiplash, and vicious market cycles. These are the primary risks you are taking on. It's a formidable trio. And hearing all this, you might be thinking, this sounds terrifying. Why would anyone in their right mind invest in this sector? It's a fair question. With all of these potential landmines, what is the appeal? The answer is simple. Because on the other side of that risk, on the other side of that volatility, lies the potential for explosive, life-changing growth. The very same forces that can cause spectacular crashes can also create legendary bull runs. The question is, how do you position yourself to survive the storms and ride the massive waves of profit? How do you tell the difference between a fund that's built to last and one that's destined to break apart? The answer lies in becoming a financial detective. You have to learn how to look under the hood, to kick the tires, and to read the fine print that separates a world-class investment from a ticking time bomb. This isn't about complex algorithms or secret Wall Street knowledge. It's about a systematic, repeatable process. A checklist. Let's build that checklist right now. Giving you the 5 critical questions you must ask before you invest a single dollar into any energy mutual fund. First, and arguably the most important question, what is the expense ratio? Think of the expense ratio as a small, relentless fee that the fund charges every single year for managing your money. It's expressed as a percentage of your investment. So, an expense ratio of 1% means you're paying $1 for every $100 you have in the fund year after year after year. Now you might think, 1%? That's tiny. What's the big deal? But in the world of investing, that's a massive deal. It's a guaranteed headwind blowing against your returns. Let's make this real. Imagine you invest $10,000 into Fund A with a 1% expense ratio, and your friend invests $10,000 into Fund B, which is very similar but has a 0.5% expense ratio. Let's say both funds earn an average of 8% per year for the next 20 years. After 2 decades, your friend's account would be worth over $5,000 more than yours. $5,000 vanished into thin air, simply because of that tiny 0.5% difference. The fee eroded your growth like a slow leak in a tire. In a volatile sector like energy, where you might have years of flat or negative returns, a high expense ratio is devastating. It's a guaranteed loss you take on, even when the fund itself isn't making you any money. As a general rule for a U.S. investor, for a passively managed energy index fund, you want to see an expense ratio well below 0.5%. For an actively managed fund, where you're paying for a manager's expertise, anything pushing above 1% should be met with extreme skepticism. You have to ask yourself, is this manager's skill really worth double or triple the cost? Most of the time the answer is no. The second question flows directly from that. Who is steering the ship and what is their map? We're talking about the fund manager and the fund's stated strategy. For an actively managed fund, the manager is everything. You're not just buying a basket of stocks. You're hiring a professional to make decisions on your behalf. So, you need to investigate them. How long has the current manager been at the helm? If they've only been there a year, then the fund's 10-year track record is completely irrelevant. It doesn't belong to them. You want to see a manager with a long tenure, someone who has navigated multiple energy cycles, both the booms and the busts. You want a captain who has sailed through a hurricane before, not one who's only ever known calm seas. Then, look at their strategy, which you can find in the fund's prospectus. What is their philosophy? Are they focused on large, stable dividend-paying giants like Exxon and Chevron? Are they hunting for smaller, high-growth exploration companies? Are they diversifying into renewable energy infrastructure? There's no single right answer, but the strategy must be clear, consistent, and logical. A vague strategy like "we invest in the best energy companies" is a red flag. Tells you nothing. A clear strategy like "we focus on midstream pipeline companies with long-term contracts to generate stable income" gives you a solid understanding of what you're actually buying. You need to know if their map and their destination align with your own financial goals. Third, you must ask, what's actually in the box? You need to look at the fund's top holdings. This is non-negotiable. Any decent financial website will list the top 10 or 25 stocks a mutual fund owns. This is your reality check. A fund can talk a big game about diversification, but the holdings list tells the real story. What you're looking for are red flags of overconcentration. If a fund has, say, 20% of its assets in one single company, your investment is no longer a diversified fund. It's a massive leveraged bet on the fate of that one company. If that company stumbles, your entire investment gets dragged down with it. A well-managed fund will typically have its largest holding at maybe 5 to 8% of the portfolio, with the top 10 holdings making up no more than 40 or 50% of the total. This ensures that no single company's failure can sink the entire ship. You also want to see diversification across subsectors. Does the fund own a mix of upstream producers, midstream pipeline operators, and downstream refiners? Or is it 100% invested in risky oil exploration stocks? Looking at the holdings is like reading the ingredients on a food label. It tells you whether you're getting a balanced meal or a box of pure sugar. Fourth, and this is where the detective work gets really interesting, how did the fund behave in a crisis? It's easy for any fund to look brilliant during a raging bull market for oil. When crude prices are soaring, everything goes up. The true test of a manager's skill and a fund's resilience is how it performs during a downturn. You need to become a financial historian and look at a chart of the fund's performance during specific, painful periods for the energy sector. Pull up the chart for 2014 to 2016, when oil prices crashed from over $100 a barrel to below $30. Look at the spring of 2020 during the pandemic lockdown. How much did the fund drop compared to its benchmark, like the S&P Energy Select Sector Index, or its direct competitors? This is called drawdown. If the overall energy market fell 40%, did this fund fall 40%? Or did it fall 50 or 60%? A fund that consistently falls harder than its peers during bad times is a sign of poor risk management. Conversely, a fund that manages to lose less, maybe it only fell 30% when the market fell 40%, is a huge green flag. It tells you the manager is not just focused on chasing returns on the way up, they are actively protecting your capital on the way down. That is the kind of stewardship you want for your long-term investment. Finally, the fifth question is a slightly more technical one, but it reveals a lot about the manager's mindset. What is the fund's turnover ratio? The turnover ratio tells you how often the fund manager is buying and selling stocks within the portfolio. A turnover ratio of 100% means that, on average, the manager has replaced every stock in the portfolio within the last year. A ratio of 25% means they hold on to stocks for an average of 4 years. Why does this matter? For two big reasons. First, high turnover costs you money. Every time the manager buys or sells a stock, there are trading commissions and other costs, which are passed on to you, the investor, and act as another drag on your returns. Second, a consistently high turnover ratio can be a red flag about the manager's strategy. It might suggest they are a frantic day trader, chasing short-term news and market noise, rather than investing with long-term conviction in high-quality businesses. A lower turnover ratio, say under 50%, often indicates a more patient, disciplined, and thoughtful approach. The manager is buying companies they believe in for the long haul, not just renting them for a few weeks. So there you have it. The 5-point inspection: expense ratio, management and strategy, holdings and diversification, crisis performance, and turnover ratio. This is your toolkit. This is how you move from being a passive passenger to an empowered pilot of your own financial journey. By asking these 5 questions, you can cut through the marketing hype and the Wall Street noise to see the true quality and structure of an energy mutual fund. You can identify the robust, well-managed funds built to weather the storms and separate them from the poorly constructed, expensive ones destined to fall apart at the first sign of trouble. So let's get practical. You've done the detective work. You've sifted through the prospectuses, you've analyzed the holdings, you've compared the expense ratios. You've identified a fund that you believe is a well-oiled machine, ready for the long haul. Now what? How do you actually take your hard-earned dollars and turn them into a stake in the energy sector? This is where the rubber meets the road, and honestly, it's far less intimidating than most people think. The very first thing you need is a doorway to the investment world. This doorway is called a brokerage account. Think of it like a specialized bank account, but instead of just holding cash, it allows you to buy, hold, and sell investments like stocks, bonds, and you guessed it, mutual funds. If you're in the United States, you've probably heard of the big players: Fidelity, Charles Schwab, Vanguard, E-Trade. Opening an account with one of these firms is usually a straightforward online process, often taking less than 15 minutes. It's your personal portal to the financial markets. But here's a critical piece of the puzzle that many beginners miss. Not all brokerage accounts are created equal. You'll generally have a choice between a standard, taxable brokerage account and a tax-advantaged retirement account, like a Roth IRA or a traditional IRA. The difference is massive, and it all comes down to taxes. With a standard taxable account, anytime your fund pays out a dividend, or if you sell your shares for a profit, you're going to owe capital gains tax to Uncle Sam for that year. It's simple and flexible, but those taxes can eat into your long-term returns. On the other hand, retirement accounts like IRAs are like a special tax shelter for your investments. With a traditional IRA, you might get a tax deduction on the money you put in now, but you'll pay income tax on the money when you withdraw it in retirement. With a Roth IRA, you put in after-tax dollars, meaning no tax break today, but all of your growth and all of your withdrawals in retirement are 100% tax-free. Let me say that again: tax-free growth. For a long-term investment in a sector like energy that can produce significant gains and dividends, letting it grow in a Roth IRA can literally save you tens, or even hundreds, of thousands of dollars in taxes over your lifetime. Deciding which account is right for you is a crucial first step before you invest a single dollar. Okay, so you've opened and funded your account. Now for the main event: buying the fund. Every mutual fund has a unique 5-letter code that ends in X. This is its ticker symbol. It's like a license plate that uniquely identifies it on the market. For example, the Vanguard Energy Fund's ticker is VJENX. The Fidelity Select Energy portfolio is FSENX. Once you've done your research and picked your fund, you just need this ticker symbol. You'll log into your brokerage account, go to the Trade or Invest section, and you'll see a search box. You type in that 5-letter ticker symbol, and the fund's profile will pop up. This is your moment. You'll click the Buy button. Now, this is where buying a mutual fund is a little different from buying a single stock like Apple or Tesla. When you buy a stock, you can watch its price fluctuate second by second throughout the day. Mutual funds don't work like that. They only trade once per day, after the market closes. The price you get is called the net asset value, or NAV, which is calculated based on the closing prices of all the individual stocks the fund holds. This means whether you place your buy order at 10 a.m. or 3 p.m., you're getting the exact same price as everyone else who bought that day, the closing price. So there's no need to stress about timing your purchase perfectly down to the minute. The next screen will ask you how much you want to invest. And here lies one of the greatest advantages of mutual funds for beginners. You can typically invest by dollar amount, not just by number of shares. You don't have to worry about a share price of, say, $73.42. You can simply say, I want to invest $100. Your brokerage will then buy you $100 worth of that fund, even if it means getting a fractional share like 1.362 shares. This makes investing incredibly accessible. You can start with whatever amount you're comfortable with. However, be aware of one thing: minimum initial investments. Many mutual funds require a certain minimum amount for your very first purchase. This is often somewhere between $1,000 and $3,000, though some funds have no minimum at all. You'll find this information clearly listed on the fund's profile page. Don't let a high minimum scare you off. After that first investment, the minimum for any additional investments is usually much lower, often as little as $50 or even $25. And this opens the door to one of the most powerful time-tested investment strategies ever devised: dollar cost averaging. Dollar cost averaging, or DCA, sounds complex, but the concept is beautifully simple. It means you invest a fixed amount of money on a regular schedule, say $200 on the first of every month, no matter what the market is doing. You don't try to time the market. You don't try to guess if prices are high or low. You just invest consistently like clockwork. Why is this so powerful, especially for a volatile sector like energy? Because it removes emotion from the equation. When the market is soaring and everyone is greedy, your automatic investment prevents you from getting carried away and dumping all your money in at the top. More importantly, when the market crashes and everyone is panicking, your automatic investment keeps buying. And when prices are low, your fixed dollar amount buys you more shares. Think about it. If your $200 investment buys you 2 shares when the price is $100, that same $200 will buy you 4 shares if the price drops to $50. Over time, this discipline of buying more shares when they're cheap and fewer shares when they're expensive can lower your average cost per share. It turns market volatility, which scares most investors, into your secret advantage. It smooths out the bumps in the road and builds your position methodically over the long term. The best part? You can put this entire strategy on autopilot. Nearly every major brokerage allows you to set up automatic, recurring investments from your bank account into the mutual fund of your choice. You set it up once and that's it. Your $200, or whatever amount you choose, gets invested automatically every month without you having to lift a finger. It's the definition of paying yourself first and building wealth in the background of your life. It transforms investing from a series of stressful decisions into a simple, disciplined habit. So you've set up your account, you've placed your first buy order, and you've even automated your future contributions. The machine is running. Feels fantastic. But this is precisely where the real challenge, the psychological battle of investing, truly begins. Now that you own a piece of the volatile energy market, how do you handle the gut-wrenching 20% drop that will inevitably come? When do you even think about taking profits after a fund has doubled in value? And what are the catastrophic, yet common behavioral mistakes that can completely sabotage your strategy and wipe out years of disciplined gains overnight? Let's tackle these questions head-on, because they represent the single greatest challenge for any investor, not just in energy, but in any cyclical market. The decisions you make when a position is deep in the green or deep in the red will define your long-term success far more than your initial buy decision. First, let's address the catastrophic behavioral mistakes, because they are the root of all evil in portfolio management. The two most dangerous emotions in investing are not fear and greed, as the old saying goes. They are euphoria and panic. And an energy fund that has doubled in value is the perfect breeding ground for both. When your fund is soaring, when every news headline confirms your genius, when you're calculating how much you've made in a single day, you are at maximum risk. This is the peak of euphoria. The catastrophic mistake here is called recency bias. It's the psychological trap of believing that whatever has been happening recently will continue to happen indefinitely. You start thinking, if it went up 100% in a year, it can do it again. You throw out your initial plan. You might even be tempted to buy more at the top, convincing yourself that this time is different. This is how bubbles are formed, and it's how fortunes are lost. You start viewing the investment not as a position in a cyclical industry, but as a magical money-printing machine. You forget that the oil and gas industry is fundamentally a story of boom and bust. No tree grows to the sky, and no oil price goes up forever. Letting euphoria convince you to abandon all discipline is mistake number 1. And it's a killer. The second catastrophic mistake is its evil twin: panic. Let's say your fund has doubled and then, over 2 weeks, it pulls back 15%. All that euphoria instantly evaporates and is replaced by sheer terror. Your brain screams, "It's over. I'm going to lose it all." You watch the red on your screen and feel a physical sickness in your stomach. You sell everything just to make the pain stop. Then, a week later, the fund rips 20% higher, leaving you on the sidelines, having sold near the local bottom, kicking yourself for being so weak. This is panic selling. It's a reaction, not a decision. It's driven by the primal fear of loss, which studies show is twice as powerful as the pleasure of a gain. You've just experienced how quickly a paper profit can shrink, and you can't bear it. So how do you protect yourself from your own emotional brain? How do you sidestep both the trap of euphoria-driven greed and the abyss of panic-driven fear? The answer is deceptively simple, yet incredibly difficult to execute. You must have a predefined exit strategy. You must decide when you are going to sell before you are emotional. You make the rules of the game when you are calm, rational, and objective so that when the market inevitably goes crazy, you don't have to think. You just have to execute the plan you already made. So, what does an exit strategy actually look like? There are several effective models, and the best one for you depends on your own temperament. The first and most straightforward is the price target method. Before you even buy the fund, you say to yourself, "My thesis is that this fund is undervalued and will likely return to its previous highs. I will sell my entire position if the fund's price reaches X dollars." Or, "I will sell if my position is up 80%. It's a simple, clear binary rule. The beauty of this is its discipline. It forces you to take profits off the table. The primary goal of investing isn't to catch the absolute top of every move. It's to systematically make money. Paying yourself by selling a winner is never a bad decision. The downside, of course, is that the fund might blow right past your target and run another 50% higher. This can lead to a feeling of regret, but let me tell you, the regret of booking a solid 80% gain is infinitely better than the regret of watching an 80% gain turn into a 10% loss because you got greedy. The second, and perhaps more sophisticated method, is using a trailing stop loss. This is a fantastic tool for letting your winners run, while still protecting your profits. Here's how it works. Instead of setting a fixed price to sell, you set a percentage. For example, you might decide on a 20% trailing stop. This means you will sell if the fund drops 20% from its highest price since you bought it. Let's walk through an example. You buy a fund at $50. You set a 20% trailing stop. The fund climbs to $100. Your position has doubled. Your mental stop loss is now at $80. You won't sell unless it drops to $80, which would still lock in a massive 60% gain. Now, let's say the bull market continues and the fund climbs to $120. Your trailing stop automatically moves up with it. 20% below $120 is $96. So now you'll only sell if it falls back to $96. This method allows you to participate in the upside of a powerful trend, but it automatically gets you out when the trend finally breaks and a real correction begins. It takes the emotion completely out of the selling decision. A third strategy, often used by professional investors, is scaling out or trimming. Instead of an all-or-nothing approach, you sell your position in pieces as it goes up. This is a brilliant way to manage the psychology of selling. For example, you could decide on a rule like this. Once my position is up 50%, I will sell 1/3 of my shares. If it reaches a 100% gain, I will sell another third. I will let the final third ride with a trailing stop loss. Let's think about why this is so powerful. When you sell that first third after a 50% gain, you have now taken your original capital off the table. The rest of the shares in your account are now effectively house money. The psychological pressure is instantly reduced. You can't lose. If the fund keeps screaming higher, great. You still have 2/3 of your position to capture that gain. If the fund collapses tomorrow, who cares? You already booked a great profit and got your initial investment back. Scaling out allows you to lock in gains while still participating in future upside, dramatically reducing the potential for regret on either side. Finally, there's the most advanced strategy, which is selling based on a change in the fundamentals. This isn't about price targets. It's about your core thesis. You bought the energy fund for a specific reason. Maybe you believed that years of underinvestment would lead to a supply crunch. Maybe you saw global demand recovering faster than expected. Your sell signal, then, is when that fundamental reason is no longer true. You read that OPEC has decided to flood the market with millions of new barrels. Or a new technology makes renewable energy drastically cheaper overnight. Or a global recession hits, crushing demand for oil. When the story changes, when the reason you bought in the first place is invalidated, that is your signal to get out, regardless of whether you have a gain or a loss. This requires more work, as you have to stay on top of the news and the dynamics of the energy market, but it is ultimately the purest form of investing. So which strategy is best? The one you can actually write down on a piece of paper and stick to when the pressure is on. Whether it's a price target, a trailing stop, scaling out, or a change in the fundamentals, the key is to make the decision with a clear head. Your plan is a contract with your future self. It's a set of instructions you are giving to your emotional, irrational future self who will be tempted by euphoria or paralyzed by panic. Having a robust exit strategy is what separates amateurs from professionals. Amateurs only think about what to buy. Professionals are obsessed with when to sell. They know that in a brutally cyclical sector like energy, Locking in your gains during the good times is the only way to ensure you have capital left to deploy when the next great opportunity inevitably arrives. We've now covered the entire life cycle of an investment, from finding and analyzing a fund, to building a position, to crafting a disciplined exit strategy. But there's one last piece of the puzzle, and it's arguably the most important for your long-term wealth. How does this single investment fit into your entire financial life? How much is too much to allocate to a volatile sector like energy? And what are the overarching portfolio rules that can protect you from ruin and set you up for success, no matter what happens in the oil patch? Let's answer those questions, because this is where the theory of investing meets the reality of your bank account. This is the single most important part of the entire process. You can pick the greatest energy fund in the world, but if you mismanage its position in your portfolio, it can still ruin you. The key concept, the bedrock principle for adding any specialized, high-risk, high-reward investment to your portfolio is something professional investors call the core and satellite strategy. It's simple, it's elegant, and it works. Imagine your entire investment portfolio is your own personal solar system. In the center, you have the sun. This is your core. It's massive, stable, and provides the gravitational pull that holds everything together. For most U.S. investors, this core is made up of broad, low-cost index funds. Think of an S&P 500 index fund, which owns the 500 largest companies in America, or a total stock market index fund. This is your foundation. It should represent the vast majority of your portfolio. We're talking 80, maybe 90%. Its job isn't to hit home runs. Its job is to reliably get you on base, year after year, capturing the overall growth of the entire U.S. economy. Now, orbiting that stable core, you have your satellites. These are your smaller, more targeted bets. This is where your energy mutual fund lives. A satellite could be a fund focused on technology or healthcare or international stocks or energy. These are the investments you believe have the potential for outsized growth, but they also come with outsized risk. They are much smaller and more volatile than your core. If one of them explodes, it's a shame, but it won't destroy your solar system. The sun, your core, will keep everything in its orbit. So, how big should that energy satellite be? The most common rule of thumb you'll hear from financial planners is that any single sector bet should not exceed 5 to 10% of your total portfolio. Let's be conservative and stick with 5% as our working number. If you have a $100,000 portfolio, that means no more than $5,000 should be in an energy fund. If you have $1 million portfolio, that's $50,000. This allocation cap is your first and most important line of defense. It ensures that even if the energy sector goes through a catastrophic crash, and as we've seen it can and it does, it won't cripple your entire financial future. 95% of your money is still safe and sound in your diversified core, chugging along with the broader market. It allows you to take a calculated risk without betting the farm. But this is where it gets even more powerful. Simply setting an allocation isn't enough. You need to actively manage it through a process called rebalancing. And I promise you, this one discipline can have a more profound impact on your long-term returns than picking the perfect fund. Here's how it works. You decide on your 5% allocation to your energy fund. Let's say the energy sector has a phenomenal year. Oil prices spike and your fund soars 60%. Your initial $5,000 investment is now worth $8,000. But your total portfolio also grew, let's say to $110,000. Now that $8,000 represents about 7.3% of your portfolio, not your target of 5%. The undisciplined investor, high on greed and FOMO, would say, "Let it ride. It's a winner." The disciplined investor, the one who succeeds long-term, does the opposite. They rebalance. They sell the overage, in this case about $2,500 worth of the energy fund, and they move that money back into their core holdings, which are now underweight. What did you just do? You systematically, automatically forced yourself to sell high. You took profits from an asset that has become expensive and moved them into assets that are, relatively speaking, cheaper. You didn't need a crystal ball. You just followed your plan. Now let's flip the scenario. The energy sector has a brutal year. A recession hits, demand plummets, and your fund drops 40%. Your initial $5,000 investment is now worth only $3,000. Your total portfolio might have dipped to $95,000. Now that $3,000 is only about 3.1% of your portfolio, well below your 5% target. The undisciplined investor, gripped by fear, would say, "Sell it. Get me out before it goes to zero." The disciplined investor rebalances. They see that their energy allocation is too low. So they sell a small portion of their stable core holdings, which have likely held up much better, and they buy more of the beaten-down energy fund to bring its allocation back up to 5%. What did you just do this time? You systematically forced yourself to buy low. You bought more of an asset when it was on sale, when fear was at its peak and everyone else was running for the exits. This is how you turn volatility, the energy sector's greatest weakness, into your greatest advantage. Rebalancing is a simple mechanical process that removes emotion from the equation and forces you to obey the number one rule of investing. Buy low, sell high. And that, right there, is the entire philosophy. It's the culmination of everything we've discussed. We started this journey with a simple question. What is an energy mutual fund? But we've discovered the answer is so much bigger than that. We peeled back the layers, looking under the hood to see the difference between upstream drillers, midstream pipelines, and downstream refiners. We understood that a fund isn't just a ticker symbol. It's a living portfolio of real companies run by real people. We confronted the brutal reality of the pros and cons. We saw the tantalizing potential for explosive growth and juicy dividends, but we also stared into the abyss of gut-wrenching volatility, cyclical busts, and the ever-present shadow of geopolitical chaos. We learned to think like a global strategist, understanding how a decision made in Riyadh or a conflict in Eastern Europe can directly impact the value of your shares. We grappled with the monumental force of the energy transition and what it means for the future of fossil fuels and the rise of renewables. We became financial detectives, learning how to dissect a prospectus, to hunt down the expense ratio, to scrutinize a fund manager's track record, and to understand the critical difference between active management and a passive index. And finally, today we put it all together. We learned how to take this wild, volatile, and powerful investment and tame it. We learned how to fit it into a sane, disciplined, and resilient long-term portfolio using the core and satellite strategy. We unlocked the superpower of rebalancing, turning fear and greed into a systematic process of buying low and selling high. You see, this series was never just about energy mutual funds. It was a masterclass in how to approach any specialized investment. You can now take this exact same framework and apply it to a technology fund, a healthcare fund, a real estate fund, anything. The principles are universal. Do the research. Understand the risks. Know the macro forces at play. And most importantly, have a disciplined plan for how it fits into your broader financial life. Investing successfully isn't about finding some secret stock tip or a magic bullet fund that never goes down. It's about building a system, a personal financial fortress, that can withstand the inevitable storms the market will throw at you, while still allowing you to capture its incredible long-term growth. It's about replacing emotion with a plan. You came here looking for an answer about one specific type of fund, and you're leaving with a blueprint for a lifetime of smarter investing. You now know more about this topic than 99% of the population. You have the tools to make informed, confident decisions, not just about energy, but about your entire financial future. The journey from beginner to informed investor is a powerful one, and you've just taken a massive leap forward. The real work, of course, starts now, but you are no longer navigating in the dark. You have a map, a compass, and a clear set of rules to guide you. That is the ultimate value. Not a hot stock tip, but a cold, hard strategy that works.